72 hours is a long time in markets, and when gold drops nearly 9%, silver falls more than 20%, and a private credit vehicle suddenly marks down close to 20% in a single quarter, that is not randomness. That is pressure moving through the system. And the mistake most people make is focusing on the story instead of the structure. Let us slow this down and separate noise from mechanism, because what we just witnessed is not about conspiracy. It is about leverage, liquidity, and sequencing. When exchanges raise margin requirements, leverage players do not debate macro narratives, they sell. If you are running 20-to-1 leverage and margin requirements rise by just a few percentage points, the capital call is not small, it is exponential, and when enough players are forced to meet collateral demands at the same time, price becomes a function of funding stress, not conviction. That is how metals can fall hard, even if the long-term thesis has not changed. Now layer on private credit. Many investors still think of private credit as separate from the banking system. It is not. The loans may be originated by funds, but the liquidity, facilities, hedges, and funding lines often trace back into banks. When marks move lower or redemptions tighten, the stress does not stay contained. It moves through collateral chains, and this is where sequencing matters. In our framework, this looks like phase 2 pressure building. Multiples compress. Funding becomes selective. Liquidity is still present, but it is uneven. The probability today favors continued pressure rather than immediate collapse. But the tail risk of broader credit stress is no longer theoretical. Now let us address the confiscation narrative, because that conversation is being framed incorrectly. Modern systems do not need door-to-door seizure. Wealth extraction today is administrative. It happens through taxation, reporting rails, compliance friction, and convertibility constraints. The risk is not that someone takes your gold from your safe. The risk is how easily you can convert assets into usable liquidity under new rules. That distinction matters. Quick pause here. This is educational analysis, not investment advice. The goal is understanding mechanisms so you can interpret signals more clearly. Now, if this kind of structural breakdown helps you think more clearly about markets, consider subscribing. Not because it helps the channel, but because it keeps these probability-based frameworks showing up in your feed when volatility increases. Most people react emotionally during stress. Subscribers get context before conviction. Back to the structure. What would confirm deeper stress from here? Watch credit spreads. Watch funding markets. Watch whether private credit markdowns remain isolated or start clustering. If funding tightens materially, that shifts probabilities toward phase 3 credit stress. If spreads stabilize and liquidity remains orderly, then this remains a late-cycle compression phase rather than systemic fracture. Notice what we are not doing. We are not predicting outcomes. We are tracking transitions. Because markets do not collapse from headlines, they transition when liquidity breaks. And right now, the signal is pressure, not panic. But pressure, if it compounds, changes regime. The advantage is not in guessing what happens next. The advantage is recognizing which phase we are in before consensus does. That is how you remove fear, remove hype, and stay positioned for optionality instead of certainty. And that is how you survive late-cycle volatility without surrendering to it.